Good afternoon, everyone. Excited to see you all here today. We are streaming this webinar on Facebook, on Instagram, and on various other platforms, as well as recording this for our future members. I'm excited to be starting. So, without further ado, I want to share a little bit about the work that the Chamber of Commerce is currently working on. I'm joining as the Executive Director for the Arab American Chamber of Commerce, and I'm quite excited to be joining an organization with 33 years of legacy, an organization that has hosted the Arab Economic Forum, brought in international leaders from across the globe to Detroit, to Michigan, to bring in international business, as well as a chamber that has been active for its many members for at least 30 years. As we continue to grow and expand this organization, I'm excited for the new announcements to come and the new ways we plan to bring value to our members. Today is an exciting event where we get to share with you a speaker who has been near and dear to us and our organization for many years, Will Adams, Senior Vice President and Chief Economist at Comerica Bank. Bill leads Comerica's economics department, providing research and analysis that impact the bank's key metrics, and as well as business leaders and policymakers throughout the country. So Bill joined Comerica back in 2022 after spending the previous 10 years with PNC Financial Services Group. In that capacity, he served as the Senior Vice President and Senior Manager Economist. Bill contributed to the forecasts and analysis of the U.S. national economy and regional economics with PNC's core footprint. He also provided forecasts of international economic conditions, interest rates, and exchange rates, covering major foreign developed and developing economies. As an expert financial forecaster, Bill's exchange rate forecasts were ranked in the 90th percentile of Bloomberg's forecast accuracy rankings, and when he left PNC. Prior to joining PNC, Bill was China resident economist for the Conference Board from 2009 to 2011. He's the co-author of In Line Behind a Billion People, How Scarcity Will Define China's Ascent in the Next Decade, published in 2013 by the Financial Times Press, and translated into Chinese in 2014 by Gusa Publishing in Taiwan. He is former president of the Economic Club of Pittsburgh, a local chapter of the National Association of Business Economics, and a former associate of the University of Pittsburgh Asian Studies Center, as well as a former co-director of the Pittsburgh-Warburg chapter of the American Council on Germany. Adam holds a master's degree from Johns Hopkins School of Advanced International Studies and a bachelor's degree from Harvard. So we have an amazing speaker with us here today, and I'm really excited to have him join us and to share his insight onto the economic prospect of Michigan and the U.S. for 2024 and forward. So without further ado, I'd like to welcome Bill Adams to join us.
Thank you, Bilal. Good afternoon. Thank you to you and to the Arab American Chamber for having me back to speak. Sorry we can't be here in person, but if you had told me that Dearborn was going to be having shorts and t-shirt weather today, 2 months ago when we started planning this, I think we could have made something happen. But you know, in January you never know. So this is second best. I write Comerica's forecasts for the economy and for our outlook for the state of Michigan. I'm here to present that to you, and the outlook for the year ahead, I think, is a good one. So this is going to be a year of normalization for the U.S. economy. After a really disruptive period since the pandemic came to our country and roiled our economy and caused a lot of you heard it a zillion times: unprecedented economic shocks, unprecedented stimulus, unprecedented this, unprecedented that. We're getting back to precedented territory, which I think is going to be a nice feeling. So. Lena, if you could bring up my first slide, let me lay out what that means specifically. So on So the next one after this. Great, thank you. So the job market in the United States is still extremely strong from a job seeker's perspective, or extremely tight if you're an employer and you're looking to recruit or retain your workers. But it's not like it was 12 months ago. It's not like it was in late 2021 or early 2022, when the job market's overheating and labor scarcity were at its worst after the pandemic. You can see this in a lot of different ways of measuring it. The unemployment rate, you don't see it that much. The unemployment rate's still near a half-century low. Latest jobs report we got for January showed it at 3.7%. And the lowest that it's been since 1969 was 3.4% at the beginning of 2023. So still a very tight job market. And the unemployment rate has really not budged since 2022, where it averaged 3.6%, same as last year. But if you look at other measures of what's going on in the labor supply and in the state of hiring and retaining workers, it's a very different picture. So the other line that I have on this chart in front of you is the number of job openings per active job seeker in the United States. Active job seeker means someone who doesn't have a job and has actively looked for a job in the last 4 weeks, and that's the official measure of unemployment in the United States. And you can see we've had a dramatic shift over the last year and a half back towards a more normal labor market. Still more a job seeker's job market than an employer's job market, but conditions by this measure are pretty close to back where they were in the last few years before the pandemic, 2017, 2018, 2019, when the job market was very strong, recruiting was very competitive, but it wasn't so strong that it was creating inflation across the economy. And inflation in those years more or less met the Fed's 2% target. So you see this as well in surveys of businesses. The National Federation of Independent Business has a widely followed small business optimism survey, or small business survey. Their key indicator from that is their optimism index. But they measure a lot of other things going on in the small business sector. And in the small businesses, in that survey, you see that the share of businesses reporting that there are few or no applicants to job openings, and that hiring is their most pressing problem, that has started to come down as well. So a sign that the a little bit more availability of workers in the job market is translating into more availability of workers for small businesses as well. Lena, could we get the next slide, please? Thank you. So what that means for wages and for wage growth is that the trend has been down somewhat in the last year. Although the rate at which wages are rising is still a solid notch above where we were before the pandemic came to the US. Now, this is looking at the rate of change of wages, not looking at their level, which is rising, is much higher than in 2019, continues to go up. And that's kind of the theme for inflation and prices more broadly across the country. We're not seeing a reversal of the big jump in prices of everything that we had since 2020. What we're seeing is a return to a more normal rate of change. And that's where we're headed back on wages, but still see that this quite tight labor market, quite strong labor market, translating into faster wage growth than we saw pre-pandemic. Fast wage growth, there's really a one side, other side to this story. If you look at the next chart, the one side, the upside to fast wage growth is something seems to change. Yeah, that's the right chart. It's just something changed in the formatting of that chart since I last looked at it. Maybe different versions of Excel, PowerPoint are at play here, but sorry about that. So what the story I want to tell with this chart is the dark blue bars here. That is looking at the income of all households in the United States and how much it's grown in the current month versus the same month a year earlier, and adjusting it for how much the cost of living has risen over that same period. And you see in the date labels are off, but if you look in the middle of the chart and to the right where you see an outright decline in income growth, that is 2022 and early 2023, when the cost of gasoline was surging, the cost of food was surging. We had that crazy jump in egg prices in last winter, and as well as big increases in the cost of rent and of house prices. And so we had a significant period in which income growth lagged behind the increase in prices, so translating into a decline in the real standard of living for American households. This is a pretty painful period. And while economists like the standard definition of a recession is you need to see a decline in employment, in incomes, in production, and many different measures of the economy that is broad-based across the economy, lasts more than a couple of months usually. This period didn't meet that definition of a recession. By a lot of other measures, this period looked about as painful and damaging as many historical recessions. The increase in the food insecurity rate in the United States, if you look at the share of American households who had someone who skipped a meal over the course of a year because they didn't have money for food, couldn't get food, that rose almost as much from 2021 to 2022 as it rose from 2007 to 2008, which was a very severe recession by American standards. It rose more than it rose from 2000 to 2003, 2004, which was the quote unquote jobless recovery from the 2001 recession, and that hit the Midwest especially hard. So a painful period for the U.S. economy, and one where I thought the risk of a recession, as more broadly understood, was also relatively elevated. But we've now seen a reversal in the last couple of months, where income growth is again outpacing growth of prices, and consumer spending power is rising. And that is feeding a revival of the traditional engine of American economic growth, where households have more money to spend, consumers go out to stores and restaurants and spend more money, more top-line revenue for businesses, translates into more investment, more hiring, more jobs, and more consumer spending power over time. And that rising cycle of stronger spending and stronger demand fuels economic growth. So that's back where we are after a big interruption in 2022 and early 2023. Next slide, please. We're also seeing a big shift in on the supply side of the economy, meaning the amount of workers in the economy, the amount of equipment and other capital that businesses are putting to work to make all of the goods and services that power the U.S. economy. And the growth in the labor supply has really been a lot stronger than expected a year ago. And if you consider the unemployment rate was already near a record low in 2022, I was not expecting to see much in the way of labor supply growth in 2023 or into the early part of this year, because traditionally when labor supply growth comes both from young people coming into the labor force, it comes from immigration, and it comes from people who are unemployed or who aren't actively looking for jobs, starting to look for jobs and participate in the workforce. The biggest driver of labor force growth over the last few years has been the resumption of immigration since 2020, when, remember, borders were shut down because of COVID-related controls during the pandemic, and there was a big backlog of people who wanted to come to the United States and weren't able to get in. So with those pandemic-related controls lifted, we've seen a big pickup in immigration over the last 2 years, and that has fueled. We don't have the latest data on this. The axis, again, there's something funky going on with the axis, but this data actually goes through the end of 2023. In the latest data in the January jobs report, which came out last week, essentially all of the growth in people working in the United States and nearly all of the growth in people who have a job or are actively searching for a job, the quote unquote labor force, that has all or nearly all come from foreign-born workers. So that is what is keeping the supply side of the economy growing, which is helping to keep inflation on a downward trajectory because supply is growing quickly and keeping up with solid demand. Next slide, please. The Michigan economy is a slightly different story. Michigan tends to be a slower growing part of the country because the population in Michigan tends to be older, and so there's more people retiring and exiting the labor force each year. So the working age population is growing more slowly. And also because Michigan is, has industries that are not the fastest growing industries in the United States, which right now tend to be the tech industry and residential construction and energy. And Michigan doesn't have big representations of those three industries, and that is things that are keeping Michigan's economy growing more slowly. Comerica has a monthly proxy for real GDP that we use to track the health of Michigan's economy. And it's put together a bit differently from real GDP. Rather than GDP tries to measure all output in the state. And in year-over-year terms, GDP was still growing 1.8% in the third quarter of last year, which is the latest data that we have in hand. Our index of the Michigan economy also looks at the state of the job market. We look at residential housing prices adjusted for inflation. And we get a different and slightly cooler picture for Michigan's economy. And I think you see a bit more impact from the UAW strike on the state's economy in the latest data which we have, which goes towards the end of last year. As we know, the Michigan, the UAW strike ended just before Halloween last year. So people who were affected by the strike were confident that they were going to get their incomes again as the holiday spending season kicked off, which I think was a big boost for small businesses in the state of Michigan and restaurants and other consumer-facing businesses. So the Michigan economy that was the big downside risk to Michigan. And since the turn of the year, it seems like Michigan is doing okay, but is likely to continue to grow more slowly than the U.S. economy over the next few quarters and next few years, again, largely because of those demographic effects. Every time there's a recession in the United States, Michigan's had a couple of very painful recessions due to events in the auto industry and in manufacturing, in like the recession of 2001, the Great Recession of 2007 through 2009. But even in the pandemic, where the economy recovered very quickly and demand for cars and trucks was red hot, Michigan was still losing workers because of there's so many people who are close to retirement age in the state. And when there are job losses, even if there's labor demand after those job losses, people who are close to retirement age don't tend to re-enter the labor force. And so that is a longer term drag on the state. So the good news for Michigan and for the US more broadly is on the inflation front right now. The year-over-year change in inflation, and I'm on the next slide here, has now slowed to almost back to where it was pre-pandemic. Lena, could we get the next one, please? There, great, thank you. So inflation by the Fed's preferred measure of prices, that's it has a long name, the Personal Consumption Expenditures Price Index. Basically, it's measuring the cost of both all of the out-of-pocket spending by consumers and also money that's spent for Americans, but not by them directly. So think of the cost of healthcare payments to healthcare providers. So that's private insurers, Medicare, Medicaid. Those expenditures are a big part of what it costs to maintain the state quality of life of Americans. But we don't see that money coming directly out of our pockets. It's indirectly, either through tax money that we pay to the government that pays for Medicare and Medicaid, or through our insurance premiums that go on to pay for healthcare expenditures. So all of those added together, you see a big slowdown in inflation in year-over-year terms in the last few months, although still a solid notch above where we were pre-pandemic. Now, when I give this presentation face-to-face, I sort of have an easier job right now because I don't. It would be nice to see your faces most of the time, but this is the part of the presentation where people tend to look skeptically at me, and that's fine. And a lot of that skepticism, which I understand, is because if you're only looking at the year-over-year change in prices, that's prices in the latest data is for December last year, so December of 2023 versus December of 2022, you're missing the surge in consumer costs in 2021 and most of 2022, when the pressure on American household budgets was most intense. And so while the cost of coffee now is, a cup of coffee at my neighborhood place is like $4.50. It's wild. And pre-pandemic, I could get that same cup of coffee for, I want to say it was still under $2 for a while, and then it was like up, it was like 230, 270. It wasn't anywhere near what it is today. And I'm still mentally anchored to that old price, which I remember as being the cost of a cup of coffee, like not that long ago, even though actually I was buying that cup of coffee, back when I lived in Toledo, Ohio, in 2019. It's been a while now. And so it takes a while for consumer expectations to re-anchor towards more recent prices and for the experience of inflation to change. That's one reason why, if you look at surveys of consumers right now or surveys of businesses, you see that their perception of current inflation is quite a solid notch worse than what you see on this chart. And you don't see a return of inflation to historic norms of the same amount. But the trend is quite encouraging. Year-over-year comparison, it's an arbitrary number, right? It takes 365 days for the Earth to get around the sun. If the Earth got around the sun in 180 days, inflation would actually already be back to the pace that we were running between 2010 and 2019 of around 2% every 365 days, 2% every year, because inflation slowed dramatically in the second half of 2023. So it really depends on how you measure it. The takeaway is that price pressures in the U.S. are returning towards normal, but it's easy to come up with lots of ways of measuring where we're not back to normal quite yet. On the next slide, so the area where we've had, next slide, please, Lena. The area where we've had the most improvement in inflation, I think we'll get this up in a minute, is in gasoline prices and energy prices. U.S. Energy production is at a record high. This is both production of oil, but also other petroleum products, natural gas liquids, which are a feedstock for producing gasoline, and dry natural gas, which goes to heat our homes, and which we're now a big exporter of. So those energy prices, with production at a record high in the United States, that's offset the effect on domestic energy prices of first the Russia-Ukraine war and now the war in the Middle East, which, historically, you see headlines about a war in oil producing regions. You worry about energy prices shooting up in the United States. Hasn't happened this time around because there's so much domestic production. On top of that, We're also seeing very rapid growth of production of solar-powered electricity and other types of renewables. Solar electricity production, we get data on that monthly through last fall is the most recent. It's rising 17% year over year. So that is putting electricity demand, energy demand in the United States is rising a solid notch more slowly than energy production, and that's keeping prices under control. We're also seeing price relief for consumers from durable goods. So think furniture, appliances. Still that previous chart, that was I was talking about the medium blue, the dark blue line there. Durable consumer goods, appliances, as well as electronics. We saw the biggest year-over-year decline in cell phone prices in the holiday shopping season last year on record in the US. I mean, cell phones, obviously there's no data on cell phone prices from the 1960s or 1970s, but for as long as we've had them, they've never fallen like this. And you see similar trends in tablets, in computers. And so a lot of those types of goods that Americans were splurging on in 2020 and 2021 during the lockdown years, the supply chain is finally caught up, and we're seeing a return to more normal discounting at retailers, which shows up as relief for households on CPI. An area where you don't see that much of a reduction in inflation, and where I think there's still concerns that inflation could stay higher for longer than I think is kind of the most likely case, is prices for services that tend to change more slowly. So I think of them as sticky prices. The rate of change changes. Once it's high, it's going to stay high for a while. And also services where labor costs are a big input to the cost of producing that service. So think like auto repairs, childcare costs, elder care costs. And then for those sticky prices, homeowners insurance has shot up, really high inflation there, really high inflation of car insurance in the United States, because we've seen big increases in the cost of home repairs, in the cost of home prices, and in used car prices, and in cost of car repairs, and the insurance premiums for those products. Your premium set, it changes once a year. That annual change factors in the whole cost of the insurer's expected cost of providing you with repairs if something goes wrong to what you're insuring. So I'm still seeing high inflation there that I think is, again, the big upside risk to inflation for into the rest of this year. On the housing market, which is the next slide after that, house price increases have slowed quite a bit in the United States. Yeah, there we are. Thank you, Lena. And that's the dark blue line. On a national average basis, we're not seeing outright declines in house prices. Like in the Detroit metro area, house prices are back to a new record high after a couple of months of decline as mortgage rates were surging in 2022 and early 2023. And elsewhere in Michigan, pretty close to a record high in most markets, still a very tight housing market. But that rate of increase, again, is slowing to a more normal pace, and that will translate into a more normal rate of inflation in the cost of living, the shelter component of that. So either the cost of buying a home or the cost of renting a place to live should moderate over time as well. In the housing market, nationally, the balance between supply and demand now, which is my next chart, it was overwhelmingly a home sellers market in 2021 and early 2022. And that's the lightest blue line on this chart. That's the number of months of home listings in the United States divided by the monthly pace of sales. Incredibly tight housing market for a bit there. Less tight in the last 12 months, and that's largely because of new house construction and new supply coming online in the United States. But that's a really lopsided story around the country. In parts of the country that still have a lot of open space and have a lot of construction going on, that's mostly in the Sun Belt, you see a lot of new home supply. And so house prices are in outright decline in like the Dallas-Fort Worth area, or some other really hot housing markets in 2021, 2020, early 2022, which is, on balance, a healthy thing. Housing prices are really high right now, a little bit of a step back, aside for like the unfortunate folks who bought a home when house prices were at their peaks in early 2022 and then need to turn around and sell right now. They're going to have a loss, but for the rest of Americans, it would be nice to have housing become more affordable. But that return to affordability is really only concentrated in places where, again, you have a lot of new construction. And in Michigan and other parts of the country where construction is a smaller share and new home supply is a smaller share of the market, you still see a very tight housing market. And that is continuing to put upward pressure on prices. But I think so it really depends on, what are you worried about for the economy right now? If your top concern is the cost of living, I think this is probably bad news for you. If your top concern is you're worried that the economy is going to fall into a recession, your business is going to lose revenue, people aren't going to be spending in stores, I think this is net good news because house prices increasing translates into more homeowners' wealth, and people then use that to fuel spending and more revenue for businesses that serve consumers. There's a question in the Q&A about the outlook for the housing market over the summer. Housing market data that we show in our presentations is adjusted for the seasonal fluctuations in the housing market, and super seasonal market like from Memorial Day to Labor Day is where most of the housing action happens in the year. I think this coming high season for housing, we're going to see quite a few more listings than we saw in 2023. I think we'll see probably moderate to modest year-over-year increases in prices. I'm expecting the low single digits for house price increases this year relative to last year, and a solid increase in existing home sales as well as new home sales, because I think a lot of the homeowners who might have considered downsizing, might have considered moving in the last couple of years, but they've been staying put because they locked in a low mortgage rate in 2020 or 2021, and the cost of buying a new home is so high right now. With mortgage rates starting to move lower again, I expect more of those homeowners, not all of them, but more of them are going to decide, life is short, time to move, I'm going to bite the bullet. And, if I have to buy a house with a 6% or a 6.5% mortgage this year, I can make that work for a couple of years, and then I'll be able to refinance, or I expect to refinance down the road. The trends in house sales has really been driven again by new construction. So on the next slide, I break this out. New construction or sales of newly built homes rose solidly in 2023 after declines in 2021 and 2022, which were all about lack of supply. So supply is coming back for new home construction. Sales of existing homes still falling in year-over-year terms at the end of 2023, and an 8% decline in all of 2023. But I think both of those are going to return to growth next year. Multifamily, which is construction being built for the rental market, I have this on my next slide. That is a very different story. And there, multifamily construction is a lot slower than single-family construction. It's years between when a contract is signed and when the units are ready for occupancy. And there's like a huge backlog of multifamily units that were where the deal was struck in 2021, 2022, and then construction gradually got underway. We're still basically at all-time highs in the number of multifamily units that are under construction in the United States. Again, this is more of a Sun Belt story, but still see some of this in Michigan as well. And I think this is a reason why rents are rising more slowly for new leases, new residential leases. Rent price increases slowed dramatically, and I expect to see rents be close to flat for new leases year over year in 2024 from 2023. On a national basis, probably see some declines in the Sun Belt where there's lots of new construction and a lot of incentives for move into this new development. First month's rent free, 2 months free. Less of that in Michigan. But even in Michigan, one of the trends that we don't have great data on it on sort of like a monthly basis, but you do see it in surveys, is low and moderate income households. You see more people where it was phrased as households that are sharing roofs and sharing tables to deal with the cost of living. So people moving in with relatives, taking on roommates. And what that means for housing is just there's fewer household units that need to be housed. And so with fewer housing units, that's less housing demand and translating into some softness in parts of the rental market. On non-residential construction, the next slide, this is on a wild tear, and this is really a stimulus story. Look at the categories. This is construction spending. I haven't adjusted it for inflation. It's really hard to measure inflation of construction costs accurately on a high frequency basis. But the parts of construction that are going gangbusters are parts of the economy that are getting stimulus, subsidies, choose your word, from the Inflation Reduction Act. That was the big stimulus bill for the transition to the green economy. And then the CHIPS Act, which was to fund America's transition to having semiconductors produced domestically instead of having to source them from overseas. And that is the part of the economy that is where construction is growing fastest. Otherwise, non-residential construction, it's a pretty, I think, a pretty soft story. A lot of that is the weakness in office construction. And with the rise of remote work and even more companies, still talking about bringing their employees into the office more than they have in the last few years, more still isn't all the way back. And I don't think there's expectations for that. So there's just going to be less demand for office space in this country than there used to be. And it's going to be a long, slow transition to find productive uses for that space, that built environment. And I think some of it's going to be used for residential space, others going to be used for education, for childcare, for elder care, for healthcare services. But it's a long, messy process, and the economics and I think the zoning rules and the building codes are probably going to have to change to accommodate a repurposing of that space. While that's happening, I don't expect office construction to recover. But we do see, it's striking talking to Comerica clients, people who are in industries that have a tie-in to green energy or renewables. Things are red hot. Some slowdown in California in solar because of the changes in the way that Californian households are paid for their solar electricity that they sell back to the grid. But in broad strokes, that's the part of the built economy in the U.S. that's growing fastest, and the other sides are much softer. So on the next slide, my forecast for interest rates, I expect the Fed to be reducing interest rates this year. We're seeing economic growth, but on net, it's probably growth that's close to a sustainable rate in this country, close to the U.S. economy's potential pace of growth. And so I think the Fed is going to be seeing that there's a little bit of slack in the labor market, inflationary pressures are returning to normal, and reducing interest rates. But I think they're going to be somewhat cautious about how fast they cut rates. The Fed got egg on their face in 2021 and 2022 when they thought inflation was going to be transitory, was really just about supply chain disruptions. And they were unpleasantly surprised when prices rose across, goods and services of every type. And we had the worst inflation in more than 4 decades. So the Fed doesn't want to make the same mistake twice. If they mess up on setting interest rates this time, they probably would prefer to mess up by keeping rates a bit too high for a bit longer than is necessary, slowing the economy more than might be necessary, rather than cutting too early and allowing inflation to raise its ugly head again. So I think the Fed will probably wait until June for a first rate cut. Even though you're reading the financial press, it's like, oh, rate cut this, rate cut that, it's coming soon, blah blah blah. I'm not getting overly excited about it quite yet. The Fed next meets in March. I think a rate cut of that decision is very unlikely. Something would have to go wrong in a big way for the economy between now and then for them to decide to cut so early. Second quarter is possible, May or June. But I think the Fed is going to move pretty slowly after that to bring rates down to a more quote unquote normal level. I think of normal as like between 2.5% and 3% for the Fed funds rate. And if you're managing a business and your cost of borrowing is anchored to the prime rate, think 5 to 6% for prime, rather than over 8% where we are today. On longer term interest rates, I think we will see a move lower in like the most longer term yields, but I think the 10-year Treasury yield is still going to be relatively high by recent experience. And I think the cost of a 30-year mortgage, while no longer so painfully high, it's going to be one of those. It's going to be an intergenerational debate. Like if you bought a home in the 90s, you're not going to think mortgage rates are that high anymore. But if you bought your first home in the 2010s, mortgage rates are still going to seem, you're still going to be kicking yourself that you didn't have the good luck to be in the place where you wanted to live back in 2021 and lock in one of those wonderful, 3.5% mortgages that used to be available and unfortunately do not seem like they're coming back anytime soon. But with 30-year mortgage rates coming back under 6% over the next 2 years, I think we're going to see the housing market's going to do okay. Fundamental demand for housing is still very strong in the United States. People, lifestyles have changed, habits have changed, and I think that leads people to spend more time at home, both for leisure as well as for remote work and other other home uses, and I think that will translate into more housing demand. We're basically still a housing supply constrained society in the U.S. We need more housing nationally, and I think that will be a part of the economy that continues to grow. On the next slide, this is the fiscal deficit slide. Don't love to spend a ton of time on it because it's sort of an ugly chart. Fiscal deficit was in 2023, one of the big drivers of how we were able to dodge a recession. The deficit expanded pretty dramatically despite the unemployment rate holding near a half-century low. The deficit's going to be a bit smaller this year because a lot of the inflation-indexed parts of government spending, so think Social Security benefits, which track the rate of inflation in the previous year, they rose a lot less in 2024 than they rose in 2023 because inflation at the end of 2023 was not nearly as bad as inflation at the end of 2022. Similar story with Medicare and Medicaid reimbursements for healthcare providers. They're going to rise more slowly this year. Defense contractors and their contracts are, there's a lot of spending across the government that's linked to inflation, and that will rise more slowly. We're also going to see higher tax receipts from capital gains in 2024 than in 2023. 2022, if you did not have the good fortune or psychological resilience to forget it, it's a terrible year for the stock market, terrible year for the bond market. And so you didn't see the same capital gains that you typically see in a normal year for the economy, which translated into low capital gains receipts for the federal government and a bigger deficit last year. And it's going to be a different story this year because the stock market was up in 2023. We're back at a record high or close to it as we speak today. And that's going to help to close the deficit from that angle. But still a relatively large deficit. And I think that poses some upside risks to interest rates and to parts of the economy that are highly affected by interest rates, like the housing market. So my last slide is my forecast table. I think we're going to see a continued moderation of inflation, not quite back to the Fed's target in 2024, but close to it. I think we'll see decent economic growth, but a bit slower because we're not going to see that same boost from a rising fiscal deficit, and because we're not going to see, a lot of households were tapping credit cards, using installment loans last year to deal with the rising cost of living. I think that can't last forever, and we're going to see a slower pace of consumer spending growth as spending by low and moderate income households retrench. Although affluent households and I think are going to continue to grow their spending in 2024, and that'll propel overall consumer spending forward. And I think we'll see a little bit of a move up in the unemployment rate. Economists have been forecasting this for a while. We haven't been right yet, but other measures of the job market besides the unemployment rate, you do see more of a softening in the last 12 months. And I think that over time, you would expect to see that kind of headline measure of the economy reflect that as well. And then a move down in interest rates as well, which economists, I can talk your ear off about it, but I think that the long story short is lower, and that will be some good news for the economy and a bit less sand in the gears of the economy from expensive borrowing costs. Thank you again to the Chamber for having me today. I'm happy to take questions if there are any that I haven't already addressed.
Yeah, thank you again so much, Bill. That was a lot of information and quite a bit of insight into what's to come and how the history and legacy of this economy in Michigan economy specifically is playing out. I want to thank you on behalf of the Arab American Chamber of Commerce and all of the attendees who were able to join us here today. I want to open it up to a Q&A, so if you have any questions, please type them in the chat. We have a couple as well that have been sent in. But again, I just want to truly appreciate your time here, Bill, for sharing your insights on the economic outlook for 2024.
Thanks, Blas. It's been my pleasure.
Yeah.
And I look forward to joining you in person again sometime down the road when we can make the timing work.
I don't know what's more consistent, the economic forecast or the weather forecast, but either way, we'll make it work, and the food will be good. I have a question that was sent in that I think is on the tougher side, so I'll start with that. But given the current near balanced state of the housing market, with stabilized new home sales and a deep freeze in existing sales, what are the potential long-term implications for home ownership opportunities and rates, especially for the first-time home buyers and younger demographics here in Michigan?
I think in Michigan, I think the big story is like Michigan is a state with a big housing stock and a lot of older housing. And Michigan also has a lot of older office space that is where occupancy and utilization is relatively low. So I think there is a huge opportunity in the state of Michigan for people who can do redevelopment of existing space and find new uses for space. There's a housing shortage in Michigan. There's an affordability crisis for housing in much of the state, but then there's this like weird overhang of all this built space that people don't need right now, like department stores, old malls, you name it. So I think there's the opportunity is to think creatively and make partnerships between the public sector and private sector to facilitate the repurposing of that space, rather than have that just kind of sit empty and be wasted and be an eyesore.
And that does seem to be the trend of at least some federal spending and that allocation for for the transformation of commercial to residential.
Mhm.
And we'll see how that plays out. I know a lot of Michigan investors are looking at that or are currently in the midst of doing something along those lines. Um, One of the questions that I think is incredibly relevant to our chamber members, especially as we're expanding into our work in supporting small businesses, is in light of the normalization of economic growth, inflation, and the interest rates expected in this year, what implications do you foresee for Michigan small businesses and that entrepreneurial ecosystem?
Um,
And
I
let's
think
use the
sure.
definition of small business, like 100 or less employees, maybe not the
Oh, okay.
better
Right.
one.
Thank you. That's super helpful. So for companies with 100 or fewer workers, it's been really hard the last couple of years to hire and retain and train and manage your workforce. And I think that's going to get a lot easier with a more normal type of a job market. The one of the data sources that I didn't talk about today, the if you know the name ADP, they process payrolls for about a third of American businesses. ADP publishes a monthly report on employment by size of employer, and in the last, call it last year, we saw a big slowdown in hiring by the biggest companies, the biggest employers, and with like an offsetting increase in hiring by medium and kind of smaller businesses, businesses with less than 2,000 employees, businesses with less than 200 employees. Um, and that's, I think, the biggest companies, they had the deepest pockets, right? Google pays well, that's no secret. And they were able to price out a lot of smaller businesses who were looking for workers in the last couple of years. So I think that will get easier. And I think the related problems of like you get a new person, they stick around for a month and a half, they leave, they never had a chance to figure out their job and they're already gone. And the kind of skills deficit of our workforce that is really weighed on productivity and made it much more difficult to operate, I think is going to improve as well. The other side of small business, and this is one that I'm really excited about, Comerica is really excited about, is we've seen a boom in the like the side gig economy over the last couple of years, and the smallest, newest businesses, people starting new businesses it's just been like this is a golden age for entrepreneurship in the United States. Some of it is people just drive and Lyft and Uber, picking up some money on the side. Others people are starting and they have a store online on Etsy or somewhere else to sell something that they're making themselves. But like that type of small business entrepreneurship, we just haven't had that in the United States. In like we had a real economic depression for small business formation between 2009 and 2020, and we're catching up on it in a big way. You know, like say what you will about TikTok. Like I don't let my kids use TikTok, but there's like the TikTok hustle culture and the idea of like having a side gig and doing that. It's really different from like it's clear, I guess, that I'm a generation too old, or at least I feel that way, to be a TikToker or a talker of I don't even know how to say it, but
I think Talker of Ticks is the
a
formal
talker of ticks,
colloquial
yeah.
term, yeah, yeah.
So, but it is a real change, and I think it's going to be a lasting change in how the economy functions, and a good one.
Yeah, and kinda on that note of the next generation and the work that's to come with it, I think another interesting question that we've received is based in, artificial intelligence, and that's something
Yeah.
that is the buzzword, but is also, undeniably going to have an impact on the white collar workforce, and so,
Mhm.
with that rapid advancement in technologies, both consumer facing and otherwise, what do you think the impact it's going to have on the broader economy, and then specifically in places of more blue collar manufacturing, automotive, like a place like
Mhm.
Michigan? And how should businesses and professionals prepare for those changes?
I think
And this
This
is speculative, right? A lot of
Yeah,
this
it's
is,
super speculative. There's no data on it right now. So the way, like, I like to
and
look
you're a
at
data
data,
guy.
come up with a view, and there's nothing to base it on at the time for the moment. So simple answers, I don't know. So like some observations so far are that, number one, adoption has been fastest in the least regulated industries. Like, so I'm in banking, highly regulated industry. I like to joke with the bankers that for every job that gets automated by AI, we get two more jobs in AI compliance. And so it's just really slow. Banks are moving very cautiously, because there's a lot of rules we have to comply with. We have to make sure we're protecting our customers, and you have to be very, very careful in how you use a technology that's making decisions without active intervention by a person. Um, on the other hand, you look at small businesses that are selling online, or like the absolute least regulated segment of the economy is like, I'm sure everyone on this call gets them, like these texts, like where you pretend to be, oh, I'm texting the wrong number and blah 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 blah. Oh, sorry to bother you. What's your name? What are you up to? Like the scam text. The language in the scam text is so much better in 2024 than it was in 2022. Much more natural, more friendlier, more personable. They get better every year. And so like obviously no regulation of criminals. But I think that's really the not to say that, there are legitimate uses of the technology, right? But the fewer the rules you have to comply with, the easier it is to deal with AI, and the easier it is to sort of say, well, there's going to be some bumps along the way, but we can afford to take some risks. So I think a lot of these like small business owners, the Etsy store managers and so forth, there is a lot of like client interaction, customer interaction, dealing with complaints and so forth that you can probably do by using AI a lot faster than doing everything manually. And those companies, those small businesses don't have to deal with the regulatory issues and compliance issues of big companies. Um, in manufacturing, I think over time, AI is going to become an important tool that manufacturers and designers use to come up with better technology. So I think there's, that could cause some automation of jobs over time, but I think it's more likely that we just get better at design and more productive for those highly skilled engineering jobs and white collar jobs. I was talking about this with a colleague of mine in the bank, and he's older than I am, and he said, I remember back in the 90s when Excel first came out, and they said, pretty soon we're not going to need any accountants because everything's so much faster now with Excel. You don't have like I entered the industry later than too late to see these, but like there were literal like ledgers of paper that people used to track track transactions and credits and debits on the bank ledger and on company ledgers. And like all that's automatic now. Somehow there's still accountants. So and lots of them. So I think it's more likely that AI fuels people doing their jobs better and the creation of new jobs than it is to see outright job destruction.
Well, that's fair. And again, this is such a volatile technology that can be applied in almost any setting, knowing that long-term impact is going to just be a ride we're all kind of here to share.
Yeah.
Um, but on that topic of fuel and energy,
Hmm.
one of the questions we received, I think, is relevant now, especially in the wintertime in Michigan, where electric costs are going up, where
Yeah.
energy costs are feeling the highest.
Hmm.
Um, how do you feel as though the falling energy prices that did contribute to a lower inflation in 2023 are going to affect the economic outlook for Michigan in 2024, especially on those energy dependent sectors?
I think so. I think energy intensive sectors are going to do well in the United States in the next couple of years.
Yeah.
I don't think it's widely understood now that the U.S. is a net energy exporter. And so when energy price, like when the cost of oil goes up, our trade deficit falls now. And that has, for like in my what I do looking at the economy, think of something like the cost of oil going up now means that stuff we buy for consumer products from China get cheaper because the dollar's stronger and we use that to fuel our purchasing price, and American businesses can negotiate lower prices when the dollar is cheaper, a dollar stronger against the yuan. And the like for the obvious implication for the state of Michigan is electric vehicles and electric vehicle transition. I think what it means is that the falling cost of energy, it kind of cuts both ways. The EV transition, some of it, the value proposition for an electric vehicle is that when gas prices are high, well, you don't have to buy gasoline anymore. You save some money there. I was given some presentations last year in around Grand Rapids, and I was talking to a business owner who has an electric F-150. Like I've never driven the thing. I don't know what it feels like, but this man loves his electric F-150, and he was like, I want to say he was saving like $2,000 a year in gasoline because he didn't need to fill his gas tank anymore. He had like charging stations that he put in outside all of his different locations in Western Michigan. He had figured out a way where he could get from place to place and not have to stop at a charger. So it was working great for him. But if gasoline prices fall, maybe people are not going to be as anxious to get an EV. On the other hand, if natural gas prices are coming down, that means electricity prices will be cheaper too. So the relative trade-off is kind of hard to predict. And a lot of that, I think, also will be driven by solar generation at home. As solar and battery technology improve, the idea that you can just like have your car at home, it's charged by the sun, you never have to pay for it. I think that would be quite compelling for a lot of people. But I think the implications for Michigan is that demand for auto components, for batteries, for that whole supply chain is only going to increase over time. Really hard to tell the pace, and like like a lot of the headlines that we've had over the last couple of months about like Hertz is slowing down their adoption of electric vehicles. A couple of the big car makers are throttling back on their plans for the EV transition. It's really about like these companies pacing, what are they going to do specifically in 2024? I think it says very little about their plans for where do they want to be in 2034. And it's just really hard for a car maker to look at the stock price of Tesla versus the stock price of their company and say, wow, I really want my valuation to be more like what I am today versus what Tesla gets. Like it's just at the top of the house. They're under a ton of pressure to have their share price look more like Tesla's, I think is the simple takeaway. And so that's fueling the private sector's motivation to be part of that transition.
Yeah, and I'm curious if, as the need for energy is exponentially, it's growing quite a
Mhm.
bit. What does the value of land become the value of a state like Michigan, which has access to a lot of land and
Mhm.
industry simultaneously for international, local industries that are trying to find spaces for energy growth and consumption?
I think the Michigan has a lot of land. I think we're going to get a lot of solar generation on open, underutilized land in Michigan.
Okay.
The other thing that Michigan has a ton of is water, and semiconductor manufacturing is very water intensive. So, the Great Lakes states, I think, are really well positioned for the increase in manufacturing water use out of that. And, I think that's going to be a big part of how the economy changes in Michigan over the next 10 years.
Yeah, thank you for that. We have a question from Linda in the chat. Linda's a good friend. She's commenting on the small business trends tend to make those faster decisions and develop and adapt to the markets more quickly than larger ones. Um, so, what tips do you have for those starting businesses during the pandemics to seek growth? The businesses that really got their foot in the door 2020 to 2022 ish, and then are now trying to expand beyond the market impact in those years.
I think one thing, this might be something that you're already on top of, but one thing that maybe is worth mentioning is that like running a small business that's a bakery is different from being a good baker. And you can be the best baker out there, make the most delicious desserts and breads that anyone's ever tasted. But if you're not managing your cash flow and your budget and your forecasting for your business and your record keeping and taxes and all of those things, your business can run into problems even without that. So I would say, like, if you can find the time for it, attend a small business boot camp or another training program to like learn the basics of managing all of this, like the 100 hats you have to wear as a small business owner. Comerica participates in a lot of events, sort of small business boot camps, borrowing for small businesses 101, events like that. I'd be happy to introduce some of our people in Michigan who are participating in those, and we could pass on the timing of the next time we're doing one of those. But I think that is sort of, um, you know, I feel like it's really important. It's honestly not something that the Economist can help you that much with. It's not what we do, but working closely with my partners in the bank, that is a big issue that small business owners and entrepreneurs have to kind of find their way around. And it's something that, Comerica and if you bank with someone else, I won't say anything bad about any other banks. A lot of banks can help you with that, but specifically we at Comerica would love to help and talk with you about that.
Yeah, Comerica has been a great partner for the chamber for many years, and an organization we've been able to lean on. So definitely have seen a lot of that small business support from every level of entry to the market in existence. So thank you for that. The last question we have here that I've been the most curious about myself is, what is the market for access to capital, whether it's at that small level or that larger level? What does the market for capital look like in 2024 and beyond from your perspective?
So it's a complicated picture right now. I think for access to capital, there is like, if you're a gigantic business, if you're running Ford's Treasury Department, access to capital is great right now because you can issue bonds to the capital markets. The additional yield you have to pay for your borrowing above what the government is paying is pretty small right now. So credit is pretty cheap. If you're a small business, different proposition. And I think but my expectation is that appetite for small business lending in the U.S. is going to increase over the next year. And I was talking about how exciting the things are going on in entrepreneurship. Like, that's the house view at Comerica. We're investing in small business lending capabilities. So I think if you're looking for credit or you're looking to expand your business, you know, strike up a conversation with the banker. Banks find people who love to talk to come work with us, and people who love to chat and to explain what we do. Having a relationship with a banker ahead of when you need that loan is really helpful, and so that's something that I think is worth kind of investing in, a year ahead, 6 months ahead, when you think you're going to need to borrow. Or, if you need a loan today, you may find that it's a lot easier to get a loan by talking with someone who you can meet face to face and you can get to know than just dealing with an institution that you don't have a relationship with.
Oh, thank you for that. Um, Once again, Bill, I want to thank you so much for joining us here today. Your expertise and insights really have provided us with a strong understanding of not only the national economic landscape, but locally here to the state of Michigan. And that analysis and forecast that you provide, the data and the charts and all that, we'll share out, if that's okay with our members, as it was something that I think some had requested, as it brought a lot of value
That would
to
be,
them.
yeah, that would be fine.
Awesome. And so we're excited to be navigating this new landscape throughout this year alongside you and everybody else. So thank you again for joining us here at the Chamber. I'm excited for what's to come. Thank you everyone who joined us in the audience and in the different live streams. And hopefully we'll be looking forward to working alongside your organizations, your businesses as Michigan continues to grow. So thank you all again and have a great afternoon.